Hi, welcome back. This is Intro to Financial Statements, Part 2. We're going to explain and give examples of the three business activities. Before we start, I want you to imagine a business. In this example, this is an outdoor guide service. Customers purchase a service, not a physical product. The guide service leads hikes, drives customers to the trailhead and guides them on the hike. The guide service drives customers to the put-in point and gives them a guided rafting trip on a river. You could think of other businesses as well: computer repair, house cleaning, massages, pedicures, or my personal favorite, the restaurant industry. And if you haven't had dim sum yet, you owe it to yourself to have it. So think of the activities of a restaurant: obtaining money to start the restaurant from family or friends, borrowing money from a bank, then buying or renting a building, remodeling it into the perfect restaurant with a kitchen and seating area. Now it's ready for business, but wait, you must buy food to cook and hire cooks and servers. Now you are finally ready for your customers. I want you to think about these two unique examples as we move forward with a discussion of the three business activities. By the way, if you want to know the individual names for these delicious dishes, download the PowerPoint slides and go to the notes section. All businesses are involved in three types of activities: financing, investing, and operating. The accounting information system keeps track of the results of each of these business activities. And they're listed in order: financing, investing, and operations. The first thing a company has to do is get money to start their business. They either borrow money, which is called debt, or they issue and sell shares of stock for cash, which we call equity. So either debt, borrowing money that must be paid back, or equity, money that is paid in by stockholders. So if you are a small business, you're going to use your own personal money, transfer it from your bank account into the company's bank account, and you now have equity in the business. You are now an owner or a partial owner if there are other stockholders in the business. So the account title we use for that is common stock. Most small businesses start because the owner invests his or her own money in the business and has stock. When the owner takes money out of the business, that's a payment to the stockholders, and the company is paying dividends. Let's go back to debt. Most small companies don't qualify for loans from a bank. A bank is going to make you have a couple of years of history of success before they're willing to give you money. But that doesn't mean you can't borrow money from family and friends. And so you would fill out a note payable. You would give that to the family member and say, I will pay you back in 1 year, 5 years, and you would also say whether you were going to pay them interest. Bonds payable are not something we are going to study very much in Accounting 201. Bonds payable will be covered in depth in Accounting 202. But in short, they are a very long-term loan that is publicly traded on the bond market. Publicly traded stock is traded, bought and sold on the stock market, and bonds are bought and sold on the bond market. Let's look at investing. Let's say you got all the money you need, and now it's time to get resources, which we also call assets, resources that will help you run your business. So remember, in the restaurant, it might mean remodeling the kitchen for $20,000, $30,000, $40,000, buying furniture, table and chairs, maybe setting up a waiting area with some chairs and couches. We call these assets, and they usually have a life of longer than 1 year. Often furniture has a life of 10 to 30 years, depending on what kind of furniture it is. If a company has a lot of extra cash, like a Microsoft or an Amazon, they'll go out to the stock market and buy stock of other companies. But most startup companies don't have that kind of money. Finally, we come to operations. Operations cover the day-to-day purchases. Inventory, food for sale at a restaurant. It also covers revenues. This would be sales from products or services. Again, you go out for lunch, your lunch costs $15. That's the revenue that the company makes. Now, we have two major titles for revenue: sales revenue from the sale of physical products, and service revenue. So in my guided tours, the example, that's service. The customer is not buying a tangible product, they're buying an experience. The third revenue account, again, is not one we use a lot, but if a company has extra money and they put it in the bank, that's going to be the interest the company earns. Inventory, again, the guided tour outdoor company, Sierra, doesn't have inventory, but the restaurant does. They'll be buying food to sell. So inventory is something that the company buys with the intention of reselling to the customer. Another type of short-term asset is accounts receivable. If a large party came into the restaurant and the restaurant billed them and the party paid in a week, during that week the bill would be shown on the restaurant's accounting books as accounts receivable. That's the right to receive money from a customer as a result of a sale. Expenses are the cost of assets used up or services used. For example, cost of goods sold is an example of where the company had inventory, but now they've sold it to a customer in the form of a restaurant meal. So you can't keep the inventory on the accounting books. You subtract it from the inventory account and you put it in the cost of goods sold account. Services used up could be administrative assistants, it could be your marketing staff, marketing salaries, selling salaries, other selling costs, that sort of thing. Let's talk about liabilities, short-term liabilities. Liabilities arising from expenses. Now, earlier on, 2 slides ago, I talked about financing and I talked about notes payable and I talked about bonds payable. Those are long-term notes, long-term bonds, more than 1 year. Under operations, liabilities are short-term debts, things that must be paid in 30 days to a year. These are called accounts payable, interest payable, wages payable, sales tax payable, income tax payable. We'll go into these in more detail. Finally, we take the revenue accounts and we add them all up. How much was our sales? We take the expense accounts, how much did they cost, and we subtract. And if it's positive, we say we made net income or profit, and if it's negative, we say we lost money on this. All right, let's test your understanding. Cost of renting property. I want you to say whether that's an asset, liability, common stock, revenue, or expense. Cost of renting property is an expense. A truck purchased, that would be an asset. That's a resource. It has a long-term life, we hope, unless you crash it. A note payable, that's a liability. When you see that word payable, that means the company owes money to somebody. Issuance of ownership's shares, that's common stock. Amount earned from providing a service, that's a category of revenue. And finally, amounts owed to suppliers. So let's define the word supplier. Some companies use the term vendor. It's become more popular to use the term supplier. So a company buys food from cash and carry bills the company. They are called cash and carry is the supplier. And the company owes money to cash and carry, and that's going to be a liability. This ends part 2.